Okay, so we would like to welcome all of you, and we're going to get started now. We're going to focus on year-end adjustments. Right. Um, as you might have studied previously, you were taught that transactions are entered into the general ledger or into the accounting system. So you process transactions into the accounting system using source documents. That is something you have been taught. You use sales invoices, you use purchase invoices, you use deposit slips, and so forth. But now there is a certain class of transactions for which we do not have um, source documents. And these normally occur at year end when we have to make adjustments. All right. So the concept of a year end adjustment, all right, is basically based on two concepts that I'm going to share with you now. There's a concept of what we refer to as a financial year in accounting. All right. So a period of a financial year in accounting is a period of 12 months. All right. It does not necessarily have to start from January and ending in December. It's not necessarily the calendar year. But from the start or from the beginning of a financial year to the end of a financial year, we cover 12 months. So normally most reporting periods cover the financial year or 12 months. Although sometimes um, accounting entities can also prepare reports for monthly reports, for quarterly reports, or half yearly reports. We are going to deal with annual reports. So annual reporting covers 12 months. And we refer to the year as the financial year. So a financial year can start any day. For example, it can start on 1 March. So if it starts on 1 March this year, it's going to end on 28 February next year. That completes the 12-month cycle. Okay. So if our financial year starts on 1 October, for example, 2019, then it's going to span 12 months into 30 September. All right, the following year, which is 2020. All right, so when we report when we present financial reports for the year ended 30 September 2020, remember we cover from the 1st of October 2019. All right. So if you want an idea of how to know when a year started, if you are given a year ending 30 September 2020, you know that the year started tomorrow. All right. So tomorrow or the following day is 1 October. All right. So the year started the following day last year. All right. So it started 1 October 2019. So if our year end is 20th February, right, 2022, then we know that the year started the following day last year. So the following day after 20th February is 1 March, right? Last year is 2021. Okay, so that's how you determine the financial year cycle. And that is very important for adjustments. This is the second aspect I want to discuss with you. It's very important. All right, that is very important. So the second aspect is when we report, remember we have 4 financial statements. So in this discussion, we're going to focus on the statement of profit or loss and other comprehensive income. All right. So let's say statement of profit or loss, um, eh, um, profit or loss and other comprehensive income. All right. So people can you can give it that acronym, right? So this is what we report on, and this is the statement of financial performance, or we sometimes refer to it as the income statement, just to make it easy. But more correctly is the statement of profit or loss and other comprehensive income. And we're also going to focus on the statement of financial position. So the statement of financial position is going to give us the assets, the equity, and the liabilities, right? And then the income statement is going to list for us the income, and expenses so that we can determine the profit or loss made. Right. So in the income statement or the statement of profit or loss, we're going to include income, we're going to include expenses. The income that we include, the expenses that we include, should apply only to the financial year. All right. So the income applies for the 12 months only. The expenses also apply to the 12 months only. All right. So that's what we do. That's why the concept of financial year cycle is very important, because if something is not covered within that particular financial year, we're not going to report it in the income or expenses. Okay, but we're gonna report it in we will demonstrate to you how some things that some elements of income or expenditure that do not apply to this current year are going to be handled in the statement of financial position. So the adjustments is when we have amounts which are incomplete in the income and expenditure accounts, then we have to make adjustments to complete them. All right, and so that we have the full amounts being reported. Right, so now to get into the actual concepts which makes it easier for us to follow, let us start with what we refer to as accrued expenses. So remember, we are dealing with the income statement where you include expenses. So what is accrued expenses? So accrued expenses means those expenses which we haven't paid yet. Okay. So sometimes we can incur an expense, but we then do not pay it. All right. So if we haven't paid that outstanding portion of an expense is called an accrued expense. The amount outstanding, the amount owing is called accrued expense. Okay, so when we record expenses in the profit or loss statement, we record amounts we have incurred. We do not necessarily record amounts that have been paid. Rather, we actually don't record amounts in the income statement based on whether they are paid or not. We record amounts that have been incurred. All right. So given that we're talking of amounts being incurred, let us now tend to discuss the concept of incurring an expense. So when you incur an expense, this means you have benefited, all right, and now you are supposed to pay. That's all. In other words, you are liable for payment because you have benefited. Basically, that's the concept of incurring an expense. So as you can see, you can benefit from a service or a good, but then you may not pay. All right. But in that case, you should record an expense. All right. Although you haven't paid, but you must record an expense because you have benefited and you are liable for payment. Okay. So regardless of whether you paid or not, the full amount that you incurred during the financial year cycle for 12 months should be recorded as the expense. Okay. So if we have an accrued expense, it means some portion has not been paid. Right. For example, I have an example here. Let's say that we enjoyed benefits or amount incurred, which is included in the income statement. Let's say the amount incurred is 50,000, right? This is the charge that we charged, but we only recorded amounts using the source documents. So when we were using source documents, we recorded 40,000, which represent the amount paid. This 40,000 will be displayed in the list of balances or extract of the trial balance, right? And this 40,000. So you see there, we incurred expenses to the tune of 50,000. We only recorded 40,000 using source documents. So the unpaid or outstanding or the owing amount is referred to as the accrued expenses. It's the 10,000, right? Which is what we incurred and what we paid. The difference between what we incurred and what we paid. The amount owing, the amount unpaid is the accrued expense, is a current liability. So, which means that in our records, we currently have 40,000 recorded as an expense. But we know that there is a 10,000 which is unrecorded. We have to include it as well, even though it's not yet paid. All right. Because our expenses are recorded based on the amounts incurred, not necessarily the amounts paid. So what we recorded is the amount paid. We need the amount incurred to disclose in the income statement. So we have to add this 10,000 to the 40 to make it 50. And in the process of adding that 10,000, you see that we're going to increase our expenses to 50. And because we haven't paid this 10,000, it's a current liability. So the effect on the basic accounting equation is that accrued expenses are going to increase liabilities. So our liabilities are going to increase because we have recorded this 10,000 owing, right? And we also recorded a decrease in equity because we have added an extra expense. So as you know, when expenses increase, our equity decreases. So the effect of accrued expenses is to increase liabilities and decrease equity. They have no effect on assets. So how do we do the adjustment? The adjustment is to increase an expense, which is basically to debit the expense, and increase the liability, which is basically to credit the accrued expenses. So here's an example that is going to help us apply these things. So the first example says that we have an entity called XYZ Traders. This is a financial year ending 31 March 2010. And if you want to know when this year started, you're going to say the following day after 31 March is 1 April. Then you say last year. So it's 2009. All right. So it started on 1 April 2009. So when we report this, we're going to report for the period 1 April 2009 to 31 March 2010. So what happened is that this entity received a bill from the municipality, and this bill is 12,500. This is for the month of March 2010, but they received it on the 15th of April, and they have to pay it at the end of April. So when we record transactions using source documents, by the end of March, which is 31 March 2010, we had not yet recorded this transaction. And why is that the case that we had not yet recorded this transaction? This is because we didn't have the source documents, but eventually we received the source document on the 15th, right, of April. But we had already closed the year. So how are we going to do with that? Okay. So what we're going to do is that we know that what we have recorded up to 31 March is not complete. We have to make additional recording for the month of March. The month of March is included because our year starts 1st of April 2009 and covers 31 March 2010. So this, we enjoyed the water and the electricity in the month of March 2010, which falls within our current financial year. Whether we paid it or not, as long as we enjoyed the benefit in the current month, we incurred the expense in the current month of March, right? So now we have to include this as part of the expenses. And how do we, and the question says we need to show the adjusting journal entries and their effect on the basic accounting equation. So we know that we have to increase our water and electricity, right, by 12,500. So we need to debit an expense. I'm sure you are now aware that when an expense increases, when we need to record an extra expense, to record, we need to debit that expense account. And as you know, all adjustments are done using the general journal. All right. So this is an adjusting entry. where something is missing and we need to correct the records. So we make an adjusting entry. Right, so the adjusting entry here is debit water. So if we debit the water and electricity account with 12,500, what that means is our water and electricity expenses increased now by 12,500. But because we didn't pay, we're going to credit accrued expenses with 12,500. Right. So we have done our debit and our credit entries. So the effect on the accounting equation is that our expenses have increased. So if expenses increase, equity decreases, as you know, right? Because if expenses increase, our profits also reduce, and that reduces the amount that the owner has in the company. So our equity is going to decrease. There's no effect on our assets, and our liabilities are going to increase by 12,500. So as I say here, always remember that accrued expenses always reduce equity and increase liabilities all the time. Also remember that when we do the adjusting entry for accrued expenses, we always debit the expense and credit accrued expenses with the amount outstanding only. All right. So after this, you can see now that the water and electricity account is corrected now. It includes this plus 12,500. So whatever the account was, we've added a 12,500. Now this is the total amount to be included in the income statement. And this is going to be a current liability in your statement of financial position. All right, so you can have your current liabilities, then you can have income received in advance. That's going to be your 12,500. Okay, so that is what we do. I hope that does make sense to you. Right, then we go to another type. This is example 2. All right, just to give us more practice on this. Right, so our example 2 says that this is the extract from the trial balance. All right, so interest expense. So we have been recording interest being when we paid. So we paid interest to the tune of 19,125. In other words, this is what has been recorded already in the financial records. And we have a mortgage of 12.5% interest mortgage worth 204,000. Then we are told a story, all right, that the mortgage was acquired on 30 June 2018. Then we need to calculate the amount of interest to be disclosed in the income statement. So the interest income disclosed is in the income statement is rather the interest expense is an expense, all right. And when we disclose an expense in the income statement, we disclose the amount incurred, all right, the amount that we've been charged, the full amount, whether we paid that amount or not. Right. Then the amount that will be disclosed in the statement of financial position is the difference between what was incurred and what was actually paid. Right. So we need to know for how long we have utilized this mortgage. It was acquired on the 30th of June. So our first job is to determine the financial year cycle. So the year ends 30 April 2019. So it started the following day, which is 1 May, all right, last year, 2018. All right. So we're covering the period 1 May 2018 to 30 April 2019. All right. So what this means is that any expenditure that we incurred, any expense that we incurred during this period should be reported in full, whether we paid that or not. So if you see there, we acquired the mortgage on the 30th of June. So we started enjoying the mortgage not in the month of June because this is at the end of the month, which is one skill you need when you're dealing with this, right? Because you need to know whether the month is included or we start from the following month. So this loan was acquired on the 30th of June, which means basically we never enjoyed or used the loan during the month of June. We started July. All right, so we start counting from July to say, okay, we will be charged from July. So we have the month of July up to December, that's 6 months. Up to December, that's 6 months. Plus, then up to April, that's 4 months, right? All right. So we utilized this loan for 10 months. So we incurred expenditure for 10 months. We incurred interest expense. We should be charged interest for the 10 months during this current financial year. So we have to calculate, say, how much did we incur? So we're going to say 12.5% being charged on this amount for 10 months. This is the amount that was incurred. And the amount incurred is what you put in your profit or loss. All right. So if you are dealing with expenses, right, then you come and you have a portion where you, under expenses, where you say interest expense or finance costs rather, then it's 21,250 and not this amount that was recorded. Okay. But this amount that was recorded is actually the amount that was paid, which means that if we owe people 21,250, right? This is 21,000, right? 250, 21,250, and we actually paid 19,125. So it means that we haven't paid 2,125. This is an accrued expense. So this is the amount that will be disclosed as a current liability in the statement of financial position, 2125. And as you know, the journal entries, right? We have demonstrated the journal entries. You're going to debit your interest expense with that 2125. So that now our interest expense, we had recorded 19,000, right? 125. So we are recording an extra 2125 to make it complete. All right. Right, and then we're going to credit accrued expenses with the same amount. So we now have recorded a liability. That's why our equity falls and our liabilities increase when we deal with accrued expenses. I hope that does make sense to you. All right, and that should be simple and straightforward. So this is the type of questions you should expect to get in your assessment. All right. Now we come to another type of expenses, which is called prepaid expenses. Now with prepaid expenses is the opposite of accrued expenses, because we made payment during the current year, but it covers not just the current year, but also some months of the next financial year. But we do not want to report, we do not want to include that expense as an expense for this current year, because it's for those months of the following year. We will record it then in the profit or loss to say this is expense for this current year. All right. So if we pay for the following year, we have to say this is not an expense for the current year. It's an expense paid in advance for the following year. That's why we say it's a prepaid. We paid in advance. All right. So the concept is like you have an amount incurred. It's 65,000. This is the amount that we report in the current financial year. But actually, we paid more during the current financial year. We paid 70,000. All right. Then after paying 70,000, so there's an excess payment which we made, which we refer to as prepayment or a prepaid expense, which applies to the following period. It's a 5,000. So when we report in the financial statements, or in the income statement rather, to be precise, when we report the expense is not the 70,000 we paid. It's the 65,000 which we incurred, right? So we have to make an adjustment to say we have recorded an expense to the tune of 70,000. That's too much. We have to reduce the expense in the accounting records. So we do an adjusting journal entry to remove the excess from the expense account. So expenses increase on the debit, right? They increase on the debit, they decrease on the credit. So what we want to do here is to decrease an expense. All right. So you're gonna go to the expense account and decrease it by 5,000. All right. Because we had recorded 70,000 on the debit, then we go on the credit and enter a 5,000. Then we have reduce the expense. Then we're gonna debit the prepaid expense or prepayment with the 5,000. Now this is a current asset. So the effect of a prepaid expense on the basic accounting equation is that it's going to increase equity. All right, since expenses are being reduced. All right, so our assets increase, right? Our equity also increases. There's no effect on liabilities. So if you pay in advance, the adjusting journal entry all the time using the general journal is debit the prepaid expense, credit the expense account. So if we do that, you will see that in the expense account, for example, let's just give by way of example. All right, so that's going to be our expense account with a debit and a credit side. Right? So we have a debit and credit there, our expense. So originally we had recorded a 70,000, remember? So we have a 70,000 here, but this is too much. And now we ended in 5,000 on the credit side to say, no, we are adjusting. So the correct amount now of the expense. So if you want to balance this expense, the correct amount is the expense account now has 65,000, right? Because it is 70,000 on this side and 5,000. So the balance is 65,000 on this particular account, which is exactly what we want because that's the amount incurred, right? I hope that this makes sense to you. So here's another example. All right. Here's an example of a prepaid expense, right? And it goes like, so we have an insurance company that paid insurance premiums, right? So before we go to read the story, let us start by determining the financial year cycle. So our year ends 31 May 2019, not so. So it started the following day last year, which means it started on 1 June, I think, 2018. So which means we are covering the period 1 June 2018 to 31 May 2019. I want to think this is correct. Right. So we are interested in any expense that applies to this current financial year. Remember, when we say it applies, we're not saying it was paid. We're saying it was incurred. In other words, we became liable for payment because we enjoyed a certain benefit on 1 June within the period 1 June 2018 to 31 May 2019. We enjoyed a certain benefit and we became liable for payment. So that's an expense. If there's anything for other years, other periods falling outside this period here, we're gonna not report that expenditure because it's not part of the current year expenditure. Right, so we see there that on 1 March 2019, all right, so this is what happened. So in 1 March 2019, remember our year ends 31 May. So 1 March, this happened during this current year. They paid 12,600 for 12 months on 1 March. and insurance premiums amounting to 9,000 was paid for the period starting 1 June 2018 until 28 February 2019. They were paid in the previous financial period. So we don't care when they were paid, as long as it's an expense for the current period. In other words, if we enjoyed the service or the insurance was to cover the months for this current year, we don't care when it was paid. We need that amount. So there's an amount of 9,000 paid last year, but applies to this current financial year because it was paid to cover the period starting 1 June to 20 February 2019. So it covers, it's an expense for this current year. We don't care when it was paid, we have to include it. But during this current year, we paid an amount of 12,600. Okay. So when we make the payment, we don't know for which period it covers. So we paid during this current year is 12,600. But if you look at this payment, it covers periods for this current year, March 2019, April 2019, May 2019, and then we close this current year. So for this 12,600, only 3 months apply to this current year. The other 9 months apply to the following year. Although we paid now, but our year closes on 31 May 2019. So the rest is for the next financial year. So this, so per month we have to know how much is the monthly insurance. So we say 12,600 divided by 12. This is monthly, and we have to remove the 9 months that doesn't apply to this current year. We subtract that. So it means that the insurance expense incurred, not necessarily paid, but incurred, which applies to this current year, a charge for the period 1 June 2018 to 31 May 2019 is only 12,150. This excess for 9 months, all right, is going to be a prepayment. We paid already for the following year, so it's going to be a prepayment. It's going to be a current asset. So if you come to your statement of financial position under current assets, you will have a portion that says prepaid expenses. Oh, all right. And then you have your 9450 there. So the adjusting journal entry there, like we said, is to debit the prepaid expense with the adjusting amount and credit the insurance expense with the adjusting amount, right? Like we demonstrated in the previous day. And we remember that for every prepaid expense, our assets are going to increase and our equity is going to increase as well. Okay, so please do remember that. So far we have covered accrued expenses, which is a current liability. We have covered prepaid expenses, which is a current asset. Moving on, we go to accrued income. So basically, accrued income is that income which we haven't received, but we're supposed to receive it. But unfortunately, for some reason, we haven't received it. In other words, in the income that you disclose in the income statement is the total income not received but earned. So we use the term earn. When you have earned the income during this current year, you go to record it. All right. Doesn't matter whether you actually received it or not. To earn means you become entitled. You have a right to receive. Doesn't matter whether you actually received, but you have a right because something has happened. Whether it's a contract or whether you delivered goods, whether you offered a service, you are now entitled to payment. So all the amounts which you are entitled to, whether received or not, is going to be the income you disclose. Okay, so you need to be entitled to receive the money. Then you disclose the full amount you are entitled to, not just what you actually received. Okay, so let's say the amount that was earned during the year for which we are entitled to receive. This was earned, all right, it's 144,000. But we actually received only 120. which means that the unreceived amount is called accrued income. We should receive that 24,000. All right. So if we have recorded 120,000 using source documents, when we make a payment, we record. When we make a payment, or rather, we receive a payment, we record. We receive a payment, we record. And based on all the payments we have received, we only have recorded 120,000. When we are actually entitled to 144. So the difference is the balancing figure called accrued income. And accrued income is a current asset in the statement of financial position. And when you disclose it in the statement of financial position, you do not disclose it as accrued income, but as together with trade receivables. You combine them. It becomes trade and other receivables. All right. So the effect on the basic accounting equation is obviously we have increased our income. We had recorded 120 as income, and we've added an extra 24,000. So our equity obviously increases, and our assets, our receivables also increase. Right? I hope this makes sense to you. So what happens is that so let's say you're dealing with your statement of financial position, then you come to your current assets, then you have your trade and other receivables. That's where you include your accrued income. It's going to be combined here. Then you also have your prepaid expenses here. All right, we've covered the prepaid expenses now. So let us go into an example of how we deal with accrued income. All right, so the first thing we need all the time is when do our financial year end? So the financial year ends on 30 September 2010. Right, so that means that it started on 1 October 2009, right? All the way to 30 September 2010. So we need any income that we became entitled to during this period is going to be recorded. So we did make this deposit on the 30th of April, all right? And it earns 12% interest per annum. So which means that the interest is going to be paid to us at the end of the year, at the end of 1 year, all right? At the end of 1 year, a full year, a few 12 months, then the bank is going to deposit our 12%. However, for the current financial year, we deposited on the 30th of April, so we did not earn any interest. We did not become entitled to any interest for the month of April. However, for the month of May, June, July, August, and September, which is 5 months, we earned interest. Not that we received, but we earned interest. So we have a case of income that was earned, but not yet received. In other words, we became entitled, okay, but we didn't receive because the contract says you will receive at the end of the year, but we have already been entitled to receive 5 months worth of interest. So the amount earned is going to be 11% of the amount for those 5 months which fall during this current year. So there we go. And we haven't received anything because the contract says we receive after 1 year. So the accrued income is 10,250. Now the adjusting journal entry, we're going to debit accrued income with 1050. We're going to credit interest income with 10,250. We credit interest income because we are increasing the income we have. And remember, income increases on the credit. So we need to increase our income. Right? And our assets are going to increase by 10,250. And our equity is also going to increase by 10,250. And there's no effect on liabilities here. So in other words, accrued income increases assets and increases equity. And there's no effect on the liabilities. Okay. Right, moving on, we have another example that we're going to deal with. This is the second example. So this is an extract from the trial balance of ABC traders. So we have ABC traders, and they have already recorded a rental income of 38,500. This is what they have already recorded. But if we go to additional information, we are told that the ABC traders lists out their office to a tenant from 1 July. Rent for February is still to be received. So we haven't received rent for February, right? And so what we want is that we have a year ending 28 February 2021. So our year started on the 1st of March 2020. So every rent earned from the 1st of March 2020, whether received or not, is going to be included. So during this current year, it's starting from 1 July, right? So from 1 July up to 28 February, right? We end for 8 months. We are entitled to receive. Whether we received or not is not important, but we became entitled for 8 months. But if we are told here that the rent for February is not received, it means that this rent here is for 7 months because the 8th month of February is not yet received. So we count from July, August, September, October, November, December, January. So we have 7 months rent received. So 38,500 is for 7 months. Therefore, the monthly rental is going to be equal to 38,500 over 7. And that's 5,500. Okay, so the monthly rental is 5,500. So which means that if the monthly rental is 5,500, we end rent for 8 months. So the rent end, which is the rent income, is 44,000. This is what we disclose under rent income, right? It's 44,000. The actual amount received is 38,500. So the accrued income or the rent receivable is 5,500. So if you want to think in terms of the journal entries, the debit and the credit, you're gonna debit your accrued income, which is an asset, 5,500. Then your rent income with 5,500. All right. So if you do this, this means that you have increased your assets with 5,500. You have also increased your income, which is your equity, with 5,500. So the most important thing for you is to identify the nature of the adjustment. Is it accrued expense? Is it prepaid expense? Is it accrued income? Or as we go now, is it income received in advance? Which is what we're going to look at now. So the case of income received in advance occurs when we receive more than the amount we earned. So we receive more than we are entitled to. All right. So maybe customers have paid for the following months as well. But when we report for this current financial year, in the income statement, we only focus on the amount earned during the months that apply to this year. So if we earned an amount of 144,000, but we actually received, customers paid 156, there is an excess received, which is called income received in advance of 12,000. So when we receive this amount of 156, we record that 156 as the amount received. But at the end of the year, we know that not all the whole amount applies to this year. So we make an adjusting entry to say, let's remove the excess because it doesn't apply to this current year. And we have what we refer to as an adjusting journal entry to adjust the amount. Right, so we need to say this income we have recorded 156. That's too much. That's not all for this year. Let's remove 12,000. Income increases on the credit. So if we want to decrease it, we debit income. So the income account is going to be debited with 12,000. Then we're going to credit income received in advance with 12,000. And this income received in advance is a current liability, all right? Because we owe the customer. We are not entitled to the money. We have received it, but we are not entitled. So the customer can come and claim if possible, but what we know for sure is that we haven't become entitled yet. So the effect is then it's going to increase liabilities because income received in advance is a liability. And it's going to reduce equity because we had recorded 156 as income, but we have reduced that by 12,000 to say, no, that's too much. The other 12,000 is not for the current year. All right. So liabilities are going to increase. Equity is going to decrease. Zero effect on assets when we deal with income received in advance. Okay, so this is quite a bit interesting. So let us give you an example that you might want to enjoy. So we have an entity called Bright Traders. So the year end is of Bright Traders is 28 February 2019. So our financial year is the period is covers from 28 February, then it's 1 March, right, 2018, all right, to 28 February 2019, all right. Right, so we are interested in knowing how much have we incurred and how much have we paid and what's the nature of that adjustment. So that's the two things we are looking for here. So we have an entity called Bright Traders. So what Bright Traders did is that they leased a portion of their factory to another company at the beginning of the current financial year for a period of 12 months. So maybe right at the 1st of March 2018. All right. Then they received rent of this amount. Right? And we are told this covers the rent for the current financial period. So what we've been told so far is that 30,696 covers 12 months. Therefore, the rent per month, right, is going to be equal to 30,696 divided by 12. No, 30696 divided by 12. So the rent per month is 2,558. So that's our story so far. And they paid for 12 months from the beginning. So what happened is that during the year, on 1 September 2018, Bright Traders informed the tenant or another company that, guys, from the 1st of October to the end of the year, we are renovating those entire factory. Please, you need to go out, right? And so they need to vacate the factory. And then the question is, what about the rent we've already paid? So you agree that it will be utilized in the next financial period when the renovations are completed. All right. So we need to count for how, because we received 30696, but we did not become entitled to everything. We only become entitled if we provide a service. But if you see here, from the 1st of October to end of February, we did not provide a service. Therefore, we are not entitled to that rent because we didn't provide a service. We could have refunded them, but we didn't. We said, we will keep the money. Later on, you can come. So we did that amount that were paid for this month was not earned by the Bright Traders. So for how many months did we not earn, but we received? So for October, November, December, January, February. So for 5 months. So it's 2,558 multiplied by 5 months. We are not entitled to that amount, right? Because although we received, we basically haven't provided the service. We do not have the right to that money. It's their money. They can ask us back. All right, so we had recorded originally as income, but we need to remove this from income to say this is no longer income. The 12,790 was not earned. So the adjusting journal entry is that we need to reduce the rental income by 12,790 and recognize income received in advance by 12,790. So this is going to reduce equity, and this is going to increase liabilities. So the amount that we're going to record in the statement of financial position is a current liability of 12,790. And the amount to disclose in the income statement as rental income is the actual amount received minus what does not apply to this year, which we received but we did not earn. So basically we earned 17, right? 906. That is for the 7 months. When we provided a service, then we became entitled. So we earned that amount and we can claim it. But for the other months, we did not provide a service, so we can't claim that. All right, so basically, this was just some insight and some discussion into some of those things which you should expect. All right, so if I would advise you anything, you need to pay more attention to adjustments, these adjustments, all right, year-end adjustments. For your assessments, if you're doing FAC 1502 in particular, but for other modules, you can just be balanced depending on how the examiners test you. But for FAC 1502 with UNISA, you need to focus more on year-end adjustments and closing off procedures. All right, more on this than others. So closing off procedures as well. So with this, we come to the end of our session. Remember we're going to post this on YouTube, so you can subscribe for more recordings if you want them. If you'd like to join our classes, or not really classes, we have free Telegram groups. So you can just WhatsApp this number and we will direct you to those free Telegram groups. You are also free if you want to join our private tutorials. Okay, you can we can direct you to Telegram. Then on Telegram, you speak with our consultants. They will help you with your needs. So thank you very much. We really hope that you guys are this is going to make a difference in your understanding.